Welcome to this explainer. Okay, today we are tackling something huge, demystifying foreign exchange risk. You know, in the massive, incredibly fast-paced global financial market, even the most seasoned traders and actually even giant multinational corporations can get completely blindsided if they don't grasp one absolutely critical concept, and that's exposure. So my goal today is to take this complex, sometimes intimidating global marketplace and turn it into a clear, manageable environment. We're going to get you those sharp takeaways you need to actually protect your capital. Let's just dive right in.
So here's our roadmap for today. We'll be covering 5 key areas. First, understanding currency fluctuations. Second, defining foreign exchange exposure. Third, a real-world example. Fourth, 3 types of risk. And finally, managing forex market volatility.
All right, Section 1, Understanding Currency Fluctuations. At its core, the forex market is just the global arena where currencies are traded. But listen, these fluctuations, they aren't random blips. They are driven by very specific catalysts. We're talking economic news, sudden shifts in interest rates, international trade activity, and, of course, global political events. All of this creates a constant barrage of information. It creates an environment that is literally, as this quote perfectly captures, like calm waves one moment and sudden storms the next. But hey, the key takeaway here isn't that you need some magic crystal ball to predict every single tick. No way. Our goal is to navigate these storms with patience. Waiting for a clear opportunity is vastly superior to just frantically reacting to every tiny price change.
Section 2, defining foreign exposure.
So what exactly is exposure? To put it simply, foreign exchange exposure is the actual, tangible measurement of how much your real-world finances gain or lose when exchange rates move unexpectedly. Think about it like this. If you trade, invest, or do business internationally, your exposure is the exact degree to which your own wallet is impacted by those currency movements. Basically, the more you rely on transactions in another currency, the significantly higher your exposure is to those sudden storms we just talked about. And this matters immensely, guys. These fluctuations can drastically, and I mean drastically, impact profits, costs, and the overall financial planning for absolutely anyone involved in global trade.
Section 3, a real-world example. Let's see how this actually plays out. Imagine you're sitting at your desk and you're making a trade on the euro versus the US dollar. Step 1, you buy the euro against the dollar because your analysis strongly suggests the euro is going to strengthen. Cool. Moving to step 2, everything is going exactly to plan. The euro rises slightly and your screen shows a nice little profit. You're probably feeling pretty confident, right? But then step 3 hits. Unexpected economic news suddenly flashes on the wire. Investors panic, they react instantly, and boom, step 4. Within minutes, the euro weakens rapidly in the exact opposite direction. What just happened? Well, you just realized your foreign exchange exposure. It's a powerful reminder that even perfectly reasonable, deeply researched ideas can fail in the literal blink of an eye when new information flips the market's direction.
Section 4, 3 types of risk. Okay, so in the forex market, uncertainty basically boils down to the possibility of losing money due to sudden price changes. And there are exactly 3 main types of risk that you absolutely have to understand. Because honestly, if you don't know what kind of risk you're facing, you can't possibly prepare an effective strategy to reduce your potential losses. Now, there is a stark contrast between the 2 most common risks. On one hand, we have transaction risk. This is your immediate short-term danger. It happens when exchange rates change during that tiny time gap between when a trade is first opened and when it's finally settled. Since currencies are constantly moving, the final value of your trade might look completely different from what you expected when you actually clicked buy. Now, on the other hand, we have translation risk, and this is an entirely different beast. It mainly affects large multinational companies. So when they have to convert their financial statements from one country's currency into another's, well, exchange rate shifts can heavily distort the reported value of their long-term assets, their profits, or their liabilities on paper. And that brings us to the third category, which is economic risk. This is the massive, big picture exposure. It shows how these long-term currency fluctuations scale up to actually impact a country's entire macroeconomic health or a global company's fundamental competitiveness. When exchange rate shifts dramatically over a period of years, it fundamentally influences macro investment decisions, international trade balances, and overall business profitability across borders. And listen, understanding all 3 of these exposures, transaction, translation, and economic, that is exactly what separates a reactive amateur from a proactive, prepared trader or business leader.
Section 5, managing forex market volatility. Now, before we go deploying any solutions, we have to honestly acknowledge the hurdles here. The disadvantages of the forex market are very real. You've got high market volatility, where prices jump incredibly fast. You've got complex market factors, like overlapping inflation and interest rate data to sift through. It strictly requires strong knowledge. I mean, this isn't a casino, right? It requires deep analysis. But honestly, perhaps the most dangerous hurdle is the emotional trading pressure. Rapid price changes cause immense stress, and that often leads to impulsive, disastrous decisions. Plus, staying cautious naturally protects you against the endless scams out there that promise incredibly easy, effortless profits.
So how do we actually mitigate those massive disadvantages? Well, smart traders use highly regulated, specialized platforms to manage their exposure. For example, there's IC Markets, which is highly rated for ultra-low spreads and really fast execution. There's XTB, known for its advanced platform and just phenomenal educational resources. And AvaTrade, which is celebrated for its built-in risk management tools. But the absolute crucial thing these platforms provide are tools like stop-loss settings, margin alerts, and strict leverage control. Guys, these aren't just fancy features. They are literally your financial seatbelts. They automatically cut your losses when a sudden storm hits, which completely removes that emotional pressure from the equation.
As we wrap up this explainer, I really want to leave you with one final thought. Are you prepared to wait for clear opportunities, or will you let the sudden storms of the market dictate your trades? Look, the global currency market is endlessly fascinating, and yeah, it is naturally volatile. But volatility is only a hazard if you walk in blindly. Remember that patience, continuous learning, and strict preparation using the right tools are absolutely your best defenses. It is entirely up to you to turn this volatility from a stressful threat into a highly manageable, navigatable environment. Thank you so much for joining me today to demystify foreign exchange risk. Now get out there and take a close look at your own exposure.